Whatever the RBD in the trial balance, it is called old RBD. Whatever in the adjustment is given called new RBD. So accountancy can be divided into three groups. One is personal account, one is real account, one is nominal account. Here, whatever the asset you purchase, you should be shown in the accounting in accounts only cost price, not the market price. Hello my dear student, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidyashram First Aid College, a Temple of Excellence, Mysuru. Today, in this session, I am going to hand Financial Accounting 1, first semester, Unit 1, Session 2 of BCom in favor of final accounts of sole trading concern. Actually, what is sole trading concern? An individual person. So we have got individual person leads to partnership, leads to joint stock company. So a single person who is going to do the business is called sole trading concern. I am going to explain detailedly now. Final accounts of sole trading concern has been divided into three groups. One is trading account, one is profit and loss account, one is the balance sheet. Which are the three items are? One is trading account, one is profit and loss account, one a balance sheet. A trading account is prepared purchase and sale, where we get the gross profit or gross loss. Whereas a profit and loss account is prepared to find out the net profit or net loss. Then we are going to prepare a balance sheet. It is not an account. It is a statement of assets and liability, which shows the financial position of the concern. So, trading account, gross profit or gross loss, profit and loss account, net profit or net loss, balance sheet. It is not an account, it is a statement of assets and liability which shows the financial position of the concern. At the end of the year, what is the position of the financial position of the concern can be understood only by balance sheet. We move on. So this is a format of final account. First we have to prepare a trading account. Then we have to prepare the profit and loss account. Then you have to prepare the balance sheet. You must have a perfect in the format, then only it becomes easy. So the closing stock of the last year becomes the opening stock. Then we have to make, the trader will make the purchase. If the goods are not up to the mark, it is purchase return, it is a net purchase. Then wages paid, direct payment. If any outstanding is there, that should be added. Wages plus outstanding, that should be added for the outer column. Then carriage inward, the goods is coming in, carriage inward is an expenditure, power is an expenditure directly connected, freight is an expenditure, manufacturing expenses is an expenditure. Then we'll make the sale. If the goods are not up to the mark, the sales will be returned to the seller. Closing stock, unsold stock, if there is any stock destroyed by fire, that can be shown here. Then we'll bring out the difference. If the credit side is more than the debit side, it is called the gross profit. If the debit side is more than the credit side, it is gross loss. I will explain. If the credit side is more than the debit side, it is called the gross profit. If the debit side is more than the credit side, it is called gross loss. So your trading account is over. Now you move on to profit and loss account. So whatever the gross profit there which has been brought down here, any income, all the incomes will be credited, all the expense and loss will be debited by gross profit brought down, by discount received, by commission received, by interest on investment, by interest on drawing. Anything drawn, if you pay the interest, income to the firm. Then here, gross loss, expenditure brought down, to salary expenditure, postage is an expenditure, electricity charge is an expenditure, discount allowed is an expenditure, carry outward goods is going out in expenditure, sundry expense means general expense is an expenditure, insurance minus if there is any prepaid, that should be deducted. If there is any outstanding, that should be added. Then printing and stationery, all expenditure we are going to put, trade expenses, commission paid, loss on stock destroyed. I will explain this one, loss on stock destroyed. Then rent and taxes, format this you have to learn, back date plus new RBD minus old RBD. I will explain this. Back date plus new R. Whatever the back date given in the trial balance, whatever the RBD in the trial balance, it is called old RBD. Whatever in the adjustment is given called new RBD. What's your formula? Back date plus new RBD minus old RBD. Then interest on bank loan, if you have taken the loan, if you pay the interest and expenditure, repair charges, division on fixed asset, division on fixed asset, division on building, division on machinery, division on furniture. Then interest on capital, because the man who has introduced the capital, for him you are going to pay. It's a loss to the firm, but gain to him. Then, if the credit side is more and the debit side is less, it is called net profit. If the debit side is more, if the credit side is less, it is called net loss. This item you have to explain. Stock destroyed. If the total stock destroyed is about 10,000, amount to be recovered from insurance company 8,000, how to treat? Entire 10,000 should be shown in the trading account. Whatever the amount you are going to receive, 8,000 should be shown on the asset side of the balance sheet as due from insurance company. The difference of rupees 2,000 should be shown on the debit side of profit and loss account as loss on stock destroyed. I will repeat. For example, if the stock destroyed is 10,000 and the amount to be recovered from the insurance company is only 8,000, so how to show here? Full value of stock destroyed should be shown on the trading account as a 10,000. How much you are going to receive? 8,000 on the asset side of the balance sheet as due from insurance company. The difference of rupees 2,000 will appear on the debit side of profit and loss account as on loss on stock destroyed. Same thing I have shown here. See the debit entry. Rent and tax expenditure, whatsoever. Then you have to prepare the balance sheet. Some role is there. First, cash in hand, cash at bank, bills receivable, debtor minus new RBD. This should be deducted. Closing stock, due from insurance company, goodwill, computer, motor car, machinery, cost minus given example again. For all the fixed, same thing you have to do. Then furniture, building, prepaid expenses. Come back here. Creditor, bills payable, bank loan, outstanding expenses. Start with the capital, opening capital, net profit should be added, interest on capital should be added, drawing should be deducted, interest on drawing should be deducted, net loss should be deducted. That is called the capital available at the end of the year. How it will go? Opening capital, add net profit of the year, add interest on capital, minus drawing, minus interest on drawing, minus net loss. So both sides should tally. So left hand side should tally to the right hand. Means liability should be equal to asset or asset should be equal to liability. Better to have this order, Then, what is actually accountancy? Accountancy refers to a systematic knowledge of accounting. It explains why, how to prepare the books of accounts, and how to summarize the accounting information, that is transaction, and communicate to the interest party. Means how to communicate, how much available, what are the things available, what is going on in accountants. At the beginning of the year, how much you got a profit. At the end of the year, how much you got. All should be communicated to the people. According to Eric Holler, accountancy is the theory and practice of accounting. It is not only theory plus practice of accounting, says Coiler. Accountancy is the theory and the practice of accounting. We'll move on. So accountancy can be divided into three groups. One is personal account, one is real account, one is nominal account. So a personal account is one which deals the accounts of person. A real account is one which deals the accounts of what's called reality. Account side. A real account is showing accounts, assets and owned by a business concern. So the assets of the concern. A nominal account is one which says the incomes and expenses of the company. So three accounts: personal, real, and nominal. So these are all the accounts of the persons with whom the business concern transaction, for example, Rama's account. Anything connected to person is called personal account. X account, Y's account, Z account, even bank account is also personal account because it follows with a name. A real account is one which shows the values of assets and liability. Debit. What are the rules of the personal account? Debit the receiver and credit the giver. Come back to real account. This shows the reality of the assets owned by a business concern. For example, it may be furniture, it may be building, it may be cash, it may be goods, it may be gold. Rule: debit what comes in, credit what goes out. For example, if the building is purchased, building is coming in, cash is going out, both are called real account. Come back to nominal account. A nominal accounts are the accounts of expenses and losses. So here it shows the expense also income. What's the rules? Debit all expenses and losses, credit all gains and income. If there is an expenditure, it should be debited. If there is an income, that should be credited. So which are the three accounts are? One is personal account, one is real account, one is nominal account. A personal account is one which deals the accounts of person. A real account is one which deals the accounts of reality, that is about the asset owned by the businessman. A nominal account is one which shows the incomes and expenses. What the rules are there? What are the principles we have to follow? Personal account: debit the receiver, credit the giver. Real account: debit what comes in, credit what goes out. What is nominal account? Debit all expenses and losses, credit all gains and incomes. Then, this is your accounting cycle, how it starts. Business transaction leads to the subsidiary books. In the subsidiary books, we have got purchase book, we have got sales book, you have got purchase return book, you have got sales return book, we have got cash book, we have got bills receivable book, bills payable book, journal proper. First we have got a transaction. Then it leads to ledger, ledger to trial balance to final account. So how it will go? First, business transaction leads to subsidiary books preparation. Then it leads to ledger, ledger to trial balance. So trial balance has two sides. One is called debit side, one is called the credit side. Debit side shows the expenses, credit side shows the income, debit side shows the asset, credit side shows the liability. Then leads to final account, where you are going to prepare trading account, profit and loss account, and a balance sheet. Then accounting cycle. Accounting principle which constitute the body of doctrine associated with the accounting serve as an explanation of the current practice. The accounting principle may be classified into group accounting concepts. What are concepts of accounting? What is actually accounting? I am going to explain now. So accounting concept. Accounting concepts are the fundamental ideas or basic assumptions underlining the theory and practice of accounting and broad working rules for all the accounting. It is not only a theory, but it's also a practice of accounting for all accounting activities. The following are the general concepts. First one, business entity concept. First you have to write business entity concept. This concept recognizes a business as a separate and distinct entity from the owner. How it will be known? Owner will be introduced money into the business. We treated owner as a separate, business as a separate. Who is the receiver? Business is the receiver. From the point of the business, we are receiving end. Who is the giver? Owner. From that end, owner. So we will act on the both sides. Here, unit as separate and distinct entity from the owner. Owner is separate, business is separate. Who is the giver? Owner. Who is the receiver? Business. So both the side, it is his own business, but he is contributing. From the point of the owner, he is the giver. From the point of the business, it is the receiver. The personal transaction owner is separated from the business side. So here, personal transaction is quite different from business. What is transaction? Transfer of property from one person to another person is a transaction. So we see from the two different angles, one as a owner, one as a business. Then going concern concept, this is also known as the concept of continuity, how the business is continue forever. Under this concept, it is assumed that business will continue forever. This is important. Business will continue forever for an indefinite period. We does not want to close any business. It will continue forever. On this concept, only financial statements are prepared. In this concept, only you are going to prepare financial statements. Come by money measurement concept. Here, according to this concept, the accounting record should reflect only those events or the facts which are capable of being measured in terms of all the things are what's called measured only in terms of money only. Every article will be valued. We say, what is the cost of this article? We say. So, everything will be measured in terms of money only. According to this concept, all asset, all liability, all income, all expenditure are regarded in terms of its time of spending. So here, it may be asset, it may be liability, it may be income, it may be expenditure. All have been regarded in terms at the time of spending for it. What's the value? Then, cost concept. As per this concept, all assets acquired by the concern are shown in the accounting record at cost only. Here, whatever the asset you purchase, you should be shown in the accounting in accounts only cost price, not the market price. These assets may not reflect the market value. So market value should not be taken into consideration. Only the real cost of the asset should be taken into consideration. Then dual concept. This is extension of double entry principles of accounting. This is the dual concept according to which assets acquired by the business out of capital invested by the owner are shown as the asset side of the balance sheet and their equivalent value in terms of money shown the liability side of the balance sheet. Example, by chance, balance sheet. This is your assets. This is your liabilities. By chance, company purchases a building worth of rupees 1 lakh. Building. Asset value. So your building formula is nothing but asset minus liability is equal to capital. A minus L is equal to C. What's your building value? 1 lakh. That is your capital. Your asset is your capital. This concept you are going to. This is a dual concept according to which asset acquired by the business out of capital invested by the owner shown on the asset side of the balance sheet and their equivalent value of money shown on the liability side of the as a capital. So building value 1 lakh, your capital also 1 lakh. Then accounting period concept. According to going concern concept, a business firm operates for an indefinite period of, however, as per this concept, the result of the business operation are evaluated in a fixed period, normally once in a year. So definitely is indefinite period, but it will be added once in a year. If it is a calendar year, January to December. If it is a financial year, it is April to March. Realization concept. According to the realization concept, which is also known as the revenue recognition concept, means how much we earn, consideration being earned on the date on which it is realized, on the date on which goods or services are transferred to the customer, either for cash or credit. When a person promised to purchase some goods, it cannot be recorded. So here, there are some goods which can be purchased in cash, some of the goods which can be purchased in the credit transaction. Here, see that whether if it is realized, then only it will be recorded. If it is not realized, it will not be recorded here. Matching concept. The objective of financial accounting is to find out trading result by preparing trading and profit and loss account. The revenue, expenditure, and income is also known as matching concept. Here, we are going to prepare a trading account, purchase and sale, which give the results of gross profit or gross loss. We prepare the profit and loss account, which gives the result of net profit or net loss. Accrual concept. This concept distinguishes between right to receive cash and actual cash received. How much money to be received, how much we have received. Similarly, obligation to pay cash and actual cash. How much money to be paid, how much you have paid. First one, how much money to be received, how much you have received. How much money to be paid, how much you have paid. In other words, under this concept, outstanding and prepaid items are accounted. And to be paid and to be received. If you paid more, it is called prepaid. If it to be received, it is called outstanding, have been recorded. What is it actually says? Accrual concept, how much cash received, how much cash to be received, how much cash paid, how much cash to be paid. All have been recorded here. Hope I have given detailed information. We have given the format of trading account. We already told what is personal account, what is real account, what is nominal account, what are the rules are, what are the concepts and convention. And I have explained trading account format, profit and loss account. So we are going to prepare the sole trading concern problem. First, we have to prepare the trading account. Then you have to prepare the profit and loss account. Then you have to prepare the balance sheet. And another thing, you have to learn the format pakka. You have to learn the format. Once you learn the format, adjust become item. So in exam, they will give the trial balance and adjustment. The items in the trial balance should appear only once. The items in the adjustment should appear twice. I'll repeat. The items in the trial balance should appear only once. The items in the adjustment should appear twice. That should be remembered while you are preparing the what's called final account problem. So we'll have it in next session with the problem. Till then, goodbye. Meet in the next session.